Good afternoon, everyone. I warmly welcome all of you to the quarterly earnings call of Hemas Holdings PLC for the quarter ended 30th June 2023. With us here today, we have Group CEO, Ms. Kasturi Chelaraja Wilson, Moiz Rehman J, Group Chief Financial Officer, Director Group Finance and Treasury, Hazel Pereira, Head of Sustainability, Ishani Rangsingha. During the call, we'll be discussing about macroeconomic parameters and how it impacted Hemas, financial performance, business insights and outlook, ESG update, followed by a Q&A session. Hazel, over to you.
Thank you, Doshi. So let's have a snapshot look at the macroeconomic parameters and the effect it had on Hemas. So we did notice that NCPI slowed down to 10.8%, but this is from an elevated base, and consumer spending we did see has not recovered to the pre-pandemic basis. Then we did experience an appreciation of the LKR, where the rates stabilized in the range of 290 to 330, and HHL, of course, being a net importer, had a favorable impact from this. Also, we did notice that global commodity prices have come down, and of course, the eased impact has been shared and passed down to the consumers by an adjustment in the prices. We also saw that, unfortunately, tax had an adverse impact on the consumers, and wallet sizes have declined. So in this particular backdrop, we will see how this has affected the market performance, as well as Kasturi will be highlighting the significant operational milestones that were achieved during the period. So Kasturi, can we please start with Home and Personal Care Sri Lanka?
Yeah, so if you talk about HPC out of the consumer spaces, the impact of high inflation of last year, even though it's easing off now, and all the macroeconomic conditions we operated in, had a huge impact on HPC. That was last year. Even this quarter, we still see that contraction in terms of the HPC volumes as a market, right? We, however, did see easing of prices, and category-wise, we saw price reductions happening purely because, like Hazel did mention, it's a combination of two things. One is the exchange itself, rupee appreciating. Second is the global commodity prices easing up. So we did see that. But we also noticed people's spending power seems to be reduced still. The wallet sizes still haven't increased. So that's why you see a contraction in the HPC itself, the market. However, value for money products and Hemas, as you know, last year I was explaining, we did launch many value for money products. We went on pack sizes, launched different products as options. And those products actually started picking up. And the impact to Hemas is that our volume contraction was only 4.5% compared to the 25% market, which was seen in terms of our shares being improving. Our categories, which we really did see impacts, positive impacts, were the baby category, baby shaming, the hair care, shampoo category, and oral care. But last year, the new space we went in terms of beauty, two brands, that is Vivia as well as Prasara was a new Ayurvedic brand. They both were getting good traction, and we are confident that those would gain momentum going forward. Yeah, and if I can touch on Atlas also while I'm in.
Yes, please, Kasturi, and also if you can also share the strategic rationale of purchasing the rest of the stake of Atlas as well.
Okay, so firstly, I'll take on. So we purchased the balance 24.9% from the owner Nirmal, the minority shareholder. That was part of the SHA we agreed. But it also fell in line with our strategy of investing into value-accretive investments. So that was a rationale. We still, Atlas in the learning segment, we still see the contraction of what we saw last year, but being the market leader, we started pivoting last year into international. We gained a lot of traction there from that business. Locally, we still hold our position as market leader. This season of the first quarter, it was off season, so we wouldn't know how the new season is going to play out. But we see that with import restrictions being lifted, we've seen a lot of value for money products coming in from China and other markets. But we also see that the global commodity prices on paper too, vis-a-vis last year, has taken a dip. So that's beneficial in terms of the cost of manufacturing. This category also has seen a reduction in prices right across, and which have been passed through to consumers. But this is always a lag effect, because what you see as parity rates now don't conform to pricing because supply chain sequences are different in that. But the good news is Atlas won the School Supply Brand of the Year at Sling, which is a prestigious People's Choice Award, and then that is testament to being the market leader.
So Kasuri, let's move on to Bangladesh. So could you please explain how the landscape in Bangladesh is responding to the macroeconomic pressures it's facing, and what kind of strategies we've been employing to navigate these challenges?
So Bangladesh macroeconomic conditions have improved a little. I mean, for them, it's stemming from, we sit here in Sri Lanka and say we have no reserves, they have positive reserves, and they're going through crisis. From them, it stems from the fact that their trade deficit continued to be big. It was tracking around $3 billion a month in terms of deficit. What we see now, that deficit has reduced. However, on a policy-wise, you still see negative lists continuing. So there is import restrictions on lots of products. You see that cost of the inflation being still high, relatively at 9%, which is high for them, and relatively mostly on food inflation. You see power shedding strategies continuing, so they are still on crisis mode. In this, how have we tracked? So the good news here for us is we continue to grow in terms of our share, but most importantly in terms of category penetration and the NPDs. Our NPDs now contribute to 16% of our Bangladesh revenue, which is from about 0% from about 3-4 years ago. So which is great for us, because that's something, Bangladesh is a market we wanted to invest in, and we tested in going deeper in the same category as well as a new category, which we saw success. Going forward in the next 2 quarters, we will be looking at some more new launches, and the objective is to use our distribution strength and our supply chain and our infrastructure capabilities, and making sure we and our branding capabilities, and growing from there. So for us, I think while the country is going through some tough times, we are looking at it positively. Yeah.
Thank you, Kasturi. So let's move on to the healthcare sector. So if you could please take us to the key factors that have contributed to the pharma business performance during this quarter, and how these results compare with the industry benchmarks.
Okay, so when I can talk about pharma, I'm talking about, again, from context, the imports and manufacturing. Overall, we saw the market as a country, the market again contracting, as having a volume degrowth of over a double digit. Remember, when the pharma category industry starts seeing contraction or degrowth, that's a serious sign of the economy, and that continued. We did see that. However, of course, Hemas, we saw low single-digit contraction, so which shows that both our businesses are growing. The imports business did see a growth in market share, but and the domestic manufacturing with our own brands. What we saw is our own brands, FMO, retaining #1 position in the molecule in the empagliflozin market. We maintain number one in terms of volume and value. We've also launched under our own brand a new hypertension product last quarter by the brand name of Bizamo. It's on the hypertension, which is a new category. We were playing in the diabetic category before. And the good news for us is that our plant crossed a 20% in terms of utilization. We still struggle with the buybacks because, as you know, it was not honored by the government, or it was our quantities were given to other players. But we've been getting some orders now because we've seen that some couldn't honor it, and there were some which failed quality. So it gave us strength to know that they come back to us because they know that we have the capability and capacity, but more importantly, it's the quality of our product going out. So the pharma cluster itself did relatively well. However, the 16% the price reduction which happened, which was effective 1st of June, mid-June, and that had a negative effect purely because the impact of that in the value chain would impact our P&L in the next few months or the next quarter, because the pharma industry, if you understand, we hold about 3 to 4 months of inventory because of the type of product it is, as well as the fact that Sri Lanka has to compete in global supply chain to get these quantities from global manufacturers. So that was the negative thing. But what more importantly, the underlying need or the other it shows is that you cannot have ad hoc price up and down from external sentiments perspective, but just to make sure that the pricing up or down comes from indicators which influence the cost of getting the product out, which means you need a pricing formula, which has been the need of the hour. What I see now is this has become a public outcry, so hopefully something would happen. I don't know, hoping that would. But the impact of this, as I said, would be seen in the next couple of months.
So let's touch upon hospitals as well. How was the quarter and what are our focus areas going to be?
So the hospital had a good quarter. While on underlying business, we've done year on year, have seen growth of utilization, occupancies of over 60%. But what was interesting is that our core surgical specialties, which we focused on, have seen growth, and that's double-digit growth. We're focusing on, as you know, digital has been on our agenda, and you don't see outcomes of it, but it is digital happens from the layers we build. We've launched home care, and that's been seeing traction, but we really want to track this, how care can be given, and access of care can be given to not confined to our hospitals, but making it accessible at home, but also tracking that cost part of it and making sure the care is seamless. So that's where digital comes in. Those will be taken through as priority. It has been we started this last year, so I'm excited mostly about hospitals because of that. Yeah.
Kasturi, let's also discuss the performance of the mobility sector.
Yeah, so I think mobility sector, when you look at Sri Lanka or the Port of Colombo or the airports got affected, particularly last year from the financial crisis. But this year, I think while the financial crisis has eased up, the volumes out of the Port of Colombo on export particularly has dropped purely because of the global contraction in consumption, be it apparel or tea, and that's the recession going on globally. But Port of Colombo, vis-a-vis last year, has seen an 8% growth. And aviation, while the cargo growth is less because perishables are the only thing which is tracking and nothing else. Passenger-wise, we've seen a growth because we see that people have started to travel. Hoping that there's confidence in the country, which would bring in more trade in terms of goods, but also in terms of people coming in to set up business. So the mobility HC sector is in an interesting place. It depends on how the country tracks, and if it does, we will be part of that journey. Yeah.
Thank you, Kasturi. So let's move on to the financial performance. So Moise, given the current challenges we have faced, could you please explain to us how all these events translated into the profitability of our businesses on a year-on-year as well as on a quarter-on-quarter basis?
Thanks, Hazel. All right, hi everybody. I'll try to put the numbers behind the business story that we've been speaking of so far. To start off with, on the top line, revenue growth, as you can see, is a fairly healthy growth of 17.2%, and this is on top of the mixed bag that we have of some market contractions in terms of volumes as well as business growth that is taking place. So the revenue growth is testament to the strength of the segments and business sectors that we're in. Now, how that translates down to the bottom line, it's a bit of a varied story. To start off with, on the GP front, as a result of the benefits that we're having from raw material prices coming down, there's some appreciation of the exchange rate, netting off the adverse impact from the selling price contractions that are taking place. Kasturi alluded on some of the examples, such as in the pharma sector. Net of all of that, there's still a GP margin growth of 1.5% compared to what was in the previous year, same quarter. But when you go further down into the P&L, how that translates into EBIT and earnings is a bit of a mixed story. On the EBIT side, we see a fairly high growth in our overheads, both selling, distribution as well as admin. A lot of it is to do with the revenue growth itself, but there's also an inflation factor that is built in there, which under the current environment of exchange rate depreciating is not necessarily proportionally representing the revenue growth as well. But despite that, we maintain a fairly healthy EBIT growth. And what you see is that there's also an improvement in the balance sheet, which is the debt levels that we have. Despite some increase in debt that we took place this quarter for the funding of the expansion that we did in the 24% of Atlas, the debt levels and the corresponding finance cost has been well contained. And the finance cost improvement is, of course, a result of predominantly the interest rates also tapering off a bit compared to where we were 1 quarter ago. And in fact, where we were even 1 year ago, there's a bit of improvement on the AWPR as well. You'll see the same benefit also reflected in our EPS. Our tax liability, which is fairly healthy in this quarter, is a result of certain timing differences that have arisen in the last 12 months in terms of what was not a tax liability in the previous financial year has triggered into tax liability this year. But what this means in terms of our effective long-term tax rates, we're pretty much at the similar healthy levels that we were in the past as well. What I like to touch on a bit more is really on the quarter-on-quarter to give a bit more context. And there you could see a revenue decline happening from Q4 of the last financial year to Q1 of this financial year. That is essentially due to a couple of seasonality. It's the number one reason for that, especially on the learning segment. Seasonality plays a big role. And that's the reason for the revenue drop from the Q4 of the last financial year to Q1 of this year. And needless to say, the revenue drop does have an impact on the margins. It has a sizable impact on the margins. And that's why you see the GP margin drop also happening. But given the kind of revenue growth that we see for ourselves in the current financial year, we see the GP margins also improving in the quarters to come, which is a result of the revenue that's going to take place. And as a result of that, the impact on the earnings also is likely to come into the bottom line. Of course, we're watching closely, like most people in business today, the finance cost, the AWPR, that we get the best rates, and how we best manage our taxes in the current environment. The impact of tax last year was only well for 6 months, but going forward, this is a reality that we have to take in and year out. Yeah, on the performance of the current year, that would be pretty much the sum of it. But I like to just continue to take on, what the challenges we're taking for the long term as well. to take you of some of the things Kasri spoke of in terms of international business and the growth pillars that we're looking at. One area that we're going to focus on quite extensively is the working capital piece, because that's going to be a key pillar, that financial pillar that enables the rest of it. As you all know, given the circumstances last year, there were working capital impacts that we saw in the group, and we need to recoup some of it back to make sure that we have the financial muscle to go into the growth paths that we're looking at. Apart from the working capital, and you can see some of the working capital improvement already showing in our balance sheet as of right now, and that's also reason why our debt levels have been contained despite the fact that we borrowed to invest in Atlas. On the growth in terms of outside of Sri Lanka, there are certain financial strategies that we need to also pursue to enable all of this in terms of what our debt portfolio is, our sources of lending. Is it just LKR? Is it just is it going to be dollars as well? Is it going to be just Sri Lanka? Is it going to be outside of Sri Lanka as well? There are certain enablers on the financial strategy that we're also working out to make the business growth pillars possible. And of course, last but not least, we maintain a healthy balance sheet strength. The financial position of the group continues to be strong, and the AAA Fitch rating that we have attained in the last couple of months, we intend to sustain and keep that even going forward.
Thank you, Moin. So, Kasri, back to you. Could you please highlight, what are the factors and strategies that have enabled the group to be resilient in the face of all these challenges?
So I'm not going to touch about the financial strengths we have, which helped us to kind of face the challenges. But more importantly, I think one element of it is the governance we've had as a group, and stemming from the board itself, which helps us take the right decision proactively. More importantly is that we were very clear. If you were with us the last 2 years or 3 years, we've been clear on what our strategy should be, what our core and what we mean by the core, and how we kind of build it in terms of a differentiate. And we were very clear of how we're building our priority strategic pillars. And why I say this is, when you're clear of what you are and how you're going to drive growth, then you also know what you're not and what you're not going to waste your time. So during crisis, we didn't waste a ton of things. We didn't do anything which was not going to be part of what was in our strategic priorities. So that was very important, to have clarity right across. And it was not only at the senior level, it was trickled right down the team, and everybody knew their role. Of course, we had an amazing team, which was multifaceted, competent leaders who they brought different things to the table. And having that team with a culture which enabled them to go and empower them to go and do their job, actually, I think is the key differentiator. If I leave this financial stuff aside, of course, it helps us that we have strong partners right across. Over the last 75 years, we've built this, right? Our farmer partners have been with us for 75 years. Our suppliers have been there. It's not over so many years. So this partnership helped us actually to have direct conversations when you need support and stuff. So those are, I think, if you ask me, that would be the key differentiator.
Thank you, Kasri. So let's get an update on the company's environment and social initiatives and the impact it has had on both the business and broader stakeholder community.
Thanks, Hazel. Good afternoon, everyone. So Hemas as a group, we continue to monitor our environmental and social topics to ensure the sustainable performance, to analyze it, and also for risk mitigation. Apart from that, we also focused on our environmental agenda as well as our purpose projects during the quarter. And to highlight some of our initiatives during this quarter is, one thing we continued our focus on was tackling marine pollution, and we have beach caretaker projects across the island where to this date we have collected over 78,000 kilograms of plastic and ensured the responsible disposal of it. Then, looking at our purpose projects, we've also worked with cancer patients to provide over 400 women with wigs. Then Atlas focused on their initiative Sitsavi, which looked at creating equal learning opportunity. And during the quarter, we impacted over 7,000 children, teachers, and parents. Atlas Learn, an initiative which focused on creating creating quality education experiences, impacted over 17,000 children. Then while we were focusing on our environmental and social initiatives, we also understood the situation the country was going through, and we wanted to support our vulnerable communities and build a social safety net. With that in mind, each of our businesses across the group focused on different initiatives around their supporting communities, the surrounding communities, and we have impacted over 8,000 families during the quarter.
So thanks, Ishani. Kasuri, we can also quickly touch upon our strategic priorities and any upcoming news in the next quarter.
So from a priority point of view, we will still go through our focus on our core and what adjacencies and you would need. There would be enhanced priority on international for the next couple of quarters. And there would be something on efficiency I'll talk about. So on the core, what we are doing for adjacencies, we are going through LRP, which is going to, we started it, which we will identify and define what we are going to do for the next 3 years. And that's a continuation. If you know, in 2020, I took it and we did it for 3 years and we're coming to the end. And I must say, we were on track on revenue and earnings. We just missed it, but still we are on track in terms of the priorities we wanted to do and the quality of business we wanted to build. So we're going through another LRP there. We continue to invest in the new services and the categories we earmarked, and then the Atlas 25% would help us to actually drive the next phase of growth. International is something we've seen good traction, and we've seen some wins in markets of the Middle East and Africa. The next 2 quarters, I want to explore and see what more we can do. You know, these kind of things, you need to invest some time and try and make one win to build a bigger growth. So that's what we're doing. We won some, and we've executed orders for a global franchise. We're having a second order for another global franchise. How can we make that work? So that's why I keep saying it will be a lot of pushing on the markets we've seen success in. International comes directly under me because it's such a priority. But seeing how the inflation is going to taper off, but our cost bases are still going to be challenging because you see there's a high attrition and people costs will have to be, we need to pay our employees so that we still be relevant as an employer. But how can we make sure that we are efficient? So we are starting this transformation project under the CTO, the Chief Transformation Officer of the group, which would focus on cost elimination. I don't keep saying saving or cost cutting, elimination of waste, but with processes and digitalization as an underpin layer, which outcomes we are looking for is uplift of GP margins and earnings margins. So eventually that should translate to greater shareholder value. So that's going to be a key project we kick off this quarter.
Thank you, Kasuri. Let's move on to the Q&A session from our participants. We've got a question, Kasuri. It reads, in terms of export business, what are the country-wise, what are the top 3 countries?
Yeah, so I think from a model perspective, export has moved from a containerized export to now market-driven export. So that's the first model. So we still have those containers going to about 20 odd countries, which I won't measure, and that's there. But where we have built on focus specific markets, we see the big markets where we succeeded is in Middle East. And when I talk about the whole of the Middle East, not one particular market, we've seen success in Bangladesh for the stationery business, and we've seen success in Africa for the stationery business and HPC. Growth, I mean, small base, so we talk about growth as an annual growth because these orders ship quarter to quarter, but generally we are tracking about 40-50% growth year on year, but that's because it's a small base. So I wouldn't even talk about growth rates. I would like to see what kind of, how deep we can go with the client, right? We did a global franchise, we did the order. If we get 2 repeat orders from the same client, and if we can use this franchise and go to different countries and supply those other countries. So if those are successful, then we know we are building a model to succeed in. And yeah, those are the 3 markets also I did mention, yeah.
Also, Kasri, do you see a price reduction in the consumer brands being offset by a volume growth going forward?
Well, our price reductions were significant. Our volume growth also was high, but we still saw market volume contraction of 4.5%. So we hopefully, if the trajectory of our market share continues, if our products still are relevant and the new products succeed, we definitely would, volume growth should supersede the price growth.
We've also got another question asking how does the recent price reduction on imported pharma products have an impact on Morrison brand manufactured locally? Sorry.
So the 16% price reduction came through essentials, and if I talk about price control and in the categories of essential medicine, say you say diabetes, you say price control it at say 20 rupees a tablet, but that doesn't mean that there is no tablet for 50 cents. You have anything between 50 cents and 20 rupees. So Morrison took a call that we play in affordable quality care while our product is as far as a global standard. And that's why we've become number 1 in terms of volume. We play at a mid-tier to give affordable pricing. What we see with the reduction is the call we take is the differential between the most expensive and ours comes down. We still are in the mid-tier. Whether we can afford to, if you don't see the cost of operations going down, because locally you have a power consumption, our electricity prices going up, the base levels are still not low. So we might take a price cut for giving back to the consumer the reductions we've seen, and that's from the API and the exchange itself from RM input. It won't be the 16% because our local input is higher, but we still retain our positioning in terms of pricing.
There's a question about Vivia's performance as well. Given the competitors' repositioning of brands, the question is, would it make sense to position Vivia as a more or less explicit fairness state?
So with me sitting here, and I think as a group, we don't advocate anybody to feel uncomfortable in their own skin. So fairness is not a proposition we'll ever advocate, and I don't think you could definitely see my skin color very well, right? So I wouldn't be advocating that as a CEO, not as the group. But what we advocate is to bring the best, and that's Vivia's positioning, and that's why it's doing well, is we try to get everybody's skin has to look good, whichever color and shape you are, whatever color you are. That's the inner glow. And how do you get the skin to be, you nourished and take care of the skin so that the best of your skin comes out. And that's the positioning. And you see Fair and Lovely also globally moving out, and they're trying to talk about glow, but it's Fair and Glow. So our positioning is strictly to Sri Lankan consumers. We give you an ingredient which is good for you, which is heirloom rice, which is vitamin B, and it works for you. It nourishes your skin, it looks after your skin the proper way. And we celebrate women to own any color of your skin, and we wouldn't shift it to fairness, put it that way.
Thank you, Kasri. So, Moiz, there is a finance-related question. It reads, why healthcare tax rate was too low in the reported quarter, and what is the effective tax rate for that particular segment?
Okay, so this is purely a result of a couple of time differences. Certain tax reductions which we were entitled to, we were able to take in quarter 1 of this financial year, and the reduction is due to that. As far as effective tax rate is concerned, we are no exception to the rest of the businesses. It's 30% that is applicable to us as well.
One more question in the it reads long-term borrowing increased by 2 billion within this particular quarter. Any capacity expansions that are taking?
Of course, this is the net of the borrowing that we took to acquire the 24% in Atlas. But I would say this is good news because despite the acquisition value being 3.4, the net growth in debt is just 2 billion, which is testament to the parallel debt repayments also that are taking place at the same time.
There's another question in line with that. What is the effective holding of the consumer segment after the acquisition of
It's 100%.
Yes. Kasri, there's one question in terms of volume. What sort of volume recovery do you expect in the coming quarters?
It'll be low single digits if that's the case. We still are not seeing huge recovery from a market perspective. When I that's from a category and market perspective, you still, because remember both, whether it's learning segment, whether it's HPC or pharmaceutical, the category itself is contracting. What we see is our growth rate of our contraction being lower. I'm hoping that what we see as the slowdown on the volume reductions will happen, and we've seen that in the last couple of months. Hopefully it'll slow down. If you want a reversal, I think you need to wait for the last quarter to see when you start seeing growth in terms of volume from a market perspective.
As another question was for you, it reads in terms of quarter-on-quarter long-term borrowing we increased by 1.7 billion, but the OD has shifted. Can you give a little insight? Is there a particular strategy behind that duration switch?
The OD and the long-term borrowing don't necessarily go hand in hand because OD is a result of the working capital levels that we have. And what you can see is quarter to quarter, there is a working capital reduction that has taken place, whereas long-term borrowing will be primarily driven by M&A that takes place, which is something we went through in quarter one. And also there may be some debt restructuring that we do time to time, none of which took place in this quarter. But these are two different debt components which have two different levers that drive them.
Kasuri, there's a question on what is the future outlook of Bangladesh consumer segment?
We are excited because we're investing more money, and because we saw the success in the second hair oil category product, Eva. And today we stand together in hair oil, we command over 14%, 14.5% together. Even Eva has market share now, so it shows in 2 years a product gaining market share in Bangladesh when you have competition is good. Because we've seen that, and even our soap doing predominantly growing, I think, at a monthly rate of about over 20%. And the planned couple of launches we have quite a bit of excitement there. And of course, so now Bangladesh as a country, as a geography, is interesting for us because we have a distribution network. We got boots on the ground. We have about 150 employees there. More than that, right? Yeah. And Atlas is also done decently well through a distribution model. Now, how do we have import and distribute? How are we going to crack that into more? Building the brand is something we need to look through. In Atlas, we're doing well in the back-to-school color products, but when you start exporting it from here and they import, the barriers or the negative list in terms of import restriction comes into play. So we need to crack that, but as a product and positioning, we know that we could succeed if we really crack the in-market entry point of view.
There's one more question in terms of Atlas. It reads, how much of Atlas's costs are linked with paper? And if there's a rise or fall in the paper prices, the demand elasticity there to accommodate these prices.
I would generally say from a portfolio point of view, there is paper and plastic, which are a big input cost for us. Paper cost is a big influencer, and as you say, yes, drought, different economic condition, even the fact that oil prices would have a significant impact. So that's where procurement plays a big part of it. Yeah, and of cost of conversion might be the other part. So from the input cost of manufacturing, input cost would take about 50 to 60% of your input cost of manufacturing. Yeah.
Yeah, those are questions that we have for the moment.
Anything else?
If there are no further questions, we can wrap up the call, or we could open up the floor for any questions.
Lucia has asked. Can we ask?
Yes, there's one question, Moise. It reads, when do you think finance costs will begin to see the positive impact of lower interest rates?
Okay. The positive impacts are already kicking in as we speak. Unfortunately, not the entire benefit could have been seen in the quarter that we just reported, because the benefits started coming into the tail end of quarter one. But with AWPR coming down, with us renegotiating our debt contracts that we have, as we speak, we see the benefit of that coming in.
There's another question. How much of palm oil is locally extracted and how much is imported? And so if the local palm oil cultivation is banned, and is it expected to be lifted? In that case, how Hemas will be benefiting from that?
So we are not in the palm oil business, nor do we use that exact extract RM for our manufacturing. But if they remove the ban and if that's a raw material available, I think we looked at it before. Because we are soaps cater to baby and adults, we are very particular about the quality. So what we've seen today is, from our personal care products point of view, most of the local available alternatives do not conform to that. Till that quality parameter is passed, we will still continue to import the quality we want from overseas.
Thank you, Kasuri. So would you like to wrap up the call, Kasuri, by giving any glimpse into our 75 years of existence as well?
Yeah, so firstly, thanks for having faith and staying with us while you respected, and I think the trust you place on the 75 years of heritage we brought in as Hemas, and the last 3 years could have been testament of being a resilient company with great governance and playing in some in defensive spaces. What you could see is that we would be building on our foundation. We are strongest as we've ever been. We know what we're good at, which also means that we know what we will pursue. International will be something we are going to build. We've seen some good success in the last couple of quarters in terms of foundation, and I feel from a Sri Lankan perspective and Hemas perspective, we could build on some of those export-oriented capabilities or product. So when I talk internationally, sometimes some of the wins we've had is in terms of OEM or outsourced production or design for people. And historically, we don't think it's product. So that's what we're excited about. I'm excited also in building the next 3 years long-term plans, because we've got a new young leadership team. We've got a diverse team. I just looked at the screen and realized we've got only Moise holding the flag here. But so looking forward to building some great, exciting businesses for the group. It'll be built on innovation. We've got a growth mindset now, and looking at long-term value creation. So thank you for your support and trust. and catch you all next quarter.